we have a remote investor student who went to the eCourse, and now what we wanted to do is give her some extra help and practice on the Analyser.
Oh, so I just looked at the information given and thought about what kind of houses that I would personally look at as like a dream house or just like scrolling through Zillow and then comparing it to this because it's like the whole like B class houses, etc., that you're looking at for rentals. And then yeah, just all the numbers, trying to make sense of it. And
Yeah,
then
it's a culture shock, right? Like
yeah.
you're not buying pretty rentals because then the numbers will make sense.
So yeah, all the typical closing costs, like looking through that, what would it be? Thinking back to the 1% and like the 50% expense rule stuff. Just
So you played around with the spreadsheet a little bit. Anything you don't understand or you thought was a little tricky?
So there was for like projected rent, that's like charging above the 1%. So can you choose? Are you choosing yourself how much to charge, or are you just leaving it to other people to put it on the market for you?
You have to, at this stage of the game, right? You haven't bought it. So it's a wild guess what the rents are, but it's not really a wild guess. And you should be able to guesstimate it within 10%. Ideally,
Then
what you want to do is you want to put in, we're guessing, we don't know what it's going to be, but we have tools which are like Zillow, Facebook Marketplace, Craigslist. I don't think you've done this yet, but you want to build a relationship with a property manager who's actually going to run this thing for you. And that's the person who's going to really be more, down to earth, what the real thing is going to rent for. But for now, since you don't know, I would recommend is just being a little bit more conservative by $500 or by $50 or so to the lower side, because this cell right here is going to drive a lot of your returns on the bottom.
And then, oh, the length of loans. So I understand loans a little bit. So why is there like a length of loan in years? And then you say the longer the better.
Yeah, so the normal loans that people get are like 15-year or 30. It's
Uh-huh.
amortized over 30 years. So it's just a simple formula that the banks use. They amortize it over that length with monthly payments. So we have it hard typed in here for 30 because there's a lot of arguments whether you should go with a shorter amortization schedule or a longer amortization schedule. And this is where people get confused, right? They hear a lot of bad financial advice where people are like, get the shorter schedule so you pay less in interest over a shorter period. Sophisticated investors know that it's a game of cash flow and delaying paying the debt off as long as possible because this is good debt. And that's
Oh, side question. When it comes to like foreclosures, do you guys ever buy those for turnkeys? Like with turnkey purposes?
so foreclosures and all these other distressed properties, they usually are a little bit more hairy and pain in the butt to work with. So a lot of our clients are like, they have good paying jobs and they're busy and they have a decent net. So a lot of those more active types of investments, those hairier deals, typically are done by lower net worth guys. And that you might put yourself in that category under $100,000 net worth. I would recommend doing something like that in the beginning, even though you can possibly make more money. It's just more risky. And I would recommend getting just a simple turn. And then once you get more confident and you actually know what the heck you're doing, then going after a little bit more potential returns doing that type of stuff. Those types of deals, you're going to need to put in more into the initial investment in terms of like repairs, right? Because a turnkey, it's implied that we're not doing too much repairs going in. We're buying it to maybe less than $5,000 for repairs. But a foreclosure, you might have to put $20,000, $30,000, $40,000, $60,000 plus. And then you got to manage the damn thing too, the construction of that thing. And that's another set of issues that you could get into, especially when you're doing this remotely, and especially when you don't know what the heck you're doing.
Okay. And then I don't quite recall if you ever mentioned something, but with all these things like property management, or if you need to put money into, let's say, maintenance or utilities, can you write it off as a business expense?
Sure can.
Okay, okay.
Yeah, you want to be smart and try and write off all these other things that potentially help your business too. What I used to do it is whenever me and my spouse, or you don't need to be married, boyfriend, girlfriend, like as you're talking business, you could potentially be using that to write off as an expense. And this is where, to me, is smart to drive if you make $2,000, $3,000 a year from this rental, to put expenses to drive that down to nothing so that you pay less taxes.
Oh, and then what do people mean by like they're writing off as expense, like business expense? Do they like apply for it or do you just?
Yeah, so in our country, and I think a lot of countries are like this, it's like a self-certified. You submit what your income minus expenses are. So on this rental, let's just say you make $3,000 for the year. You
Mhm.
want it's smart for you to accumulate expenses to pay out of your business. So this is a big difference between how normal people do their finances and investors or sophisticated money people. What regular people do is actually, let's explain first what smart people do. So smart people have the investments make money, right? Income, you make income, you pay some of these expenses here, right? That investment has. And you might have $3,000. But you need to figure out, you have your personal expenses, right? Things that you might buy, your utilities. The idea is to try and pass as many of those expenses through this business so you can drive this income down and pay less taxes on this side. Essentially, what you're doing is you're getting based on your tax bracket, whatever you can push to your business, you're going to get like a 15 to 50%. So if I bought a pizza for you and me to talk about investing, if I was like everybody else and use it out of my personal account, then I pay $20 for the pizza. What if I pushed it as a business expense, then which helped a lot of brainstorming and masterminding and good ideas and networking, then that depending what tax bracket you're in, that at the end of the taxes costed you, I don't know, $15 maybe. So it's like it's small incremental. So the term writing off is some people some people like do this the wrong way where they buy stupid stuff and they write it off. You're only saving, maybe 10 to 50 cents on the dollar. It's not smart to buy something if you don't, right? Like, you don't waste $1 to save 20, 30 cents. That's just dumb. But if you were going to spend the money on something anyway, then you try and push it through your businesses. And this is what one of the many things, like what separates the wealthy from the non-wealthy, is the wealthy people are able to push as many things through the businesses, get these little discounts on their whole bill. Whereas regular people, just your regular W-2 salary guys, they don't have the ability to do this.
And then further down the document, looking at typical closing costs. So in addition to the down payment, you also need this, is that right? This amount of money in the blue.
Oh, the typical closing costs.
Yeah.
Yeah, like about $5,000.
Mhm.
Sometimes we call this like friction costs, like it just comes apart. It's just a part of the transaction. Sometimes you can have the seller pay part of it or you do it with them. But it's just things that you need to account for. It's just not as simple as, oh, what's the property worth? 20% down payment. It's 20% down payment plus closing costs.
Okay. Okay. And then, oh, so capital expense estimator. That's just like predicting what could happen, right?
Yeah, so it's predicting this green line right here, right?
Okay.
We know we're going to have repairs, vacancy, property management. We're going to have to pay that. But this CapEx, capital expenditure, is a big unknown because we don't know when the HVAC, the flooring, the plumbing, windows needs to get renewed. But this is a really in detailed example here, but it proves the point and it illustrates how we come up with this estimation of $180 a month. And then we figure out how long it lasts, the cost per year, cost per month. And then that's where we come up with, that's how we backdoor into this, just do at least 10% to account for that stuff. So we recommend people, the first, if you buy a new house and you get a good inspection, you won't have to worry about this stuff for the first several years, right? Like you're not going to buy a house that's going to need the roof repaired next year. If not, that's on you. You're an idiot. You didn't get that fixed, or ideally you get at least like a price concession, right? If you're buying a house with a roof that's less than 5 years. In the eCourse, I think this is where a lot of investors, they put so much time and effort into analyzing deals, learning where to invest, but by the time they go through the transaction and they start to have to negotiate with the seller, they just get tired and this is a kind of an oversight. But a lot of money can be lost and made in the negotiation by having a good property inspection. And there's a few videos in the eCourse that kind of takes people through that. If there's any part where somebody needs like individual help, this would be it, because this is where experience comes in on this stuff.
Okay. Then besides that, I was looking at the next tab, the one with the 902 Swandle Road. like the trap property, because what was said about it? Oh, the property taxes are low and then they will spike when you buy it. So why does that happen?
So a lot of times, like these turnkey properties, the seller will buy the property all beat up. Like they're the ones doing the hard work, the active role. They're buying that foreclosure or distress. So it's a piece of junk when they buy it. So they might pick it up from auction or some other means at $40,000 to $50,000 or heck, $20,000. It's just a tear down at that point. They're the ones that put in a lot of rehab dollars. But from a tax perspective, the county assesses the value of the property at the piece of junk it is a year ago. But when they rehab it, and especially when you take over, the property is worth a lot more because it's been renewed. Therefore, the taxes and the city and county, they want to get their money. So they're Johnny on the spot when they're trying to appraise the assessment value. So this is a common mistake that new investors make, right? They ask the seller what the taxes are at that point, but they don't realize that it's based on the lower amount.
Okay, and then I think the rest is pretty straightforward.
Yeah, going back to the taxes stuff, the real estate and your returns are awesome, but when you start to like layer on top of these different wealth building strategies, like funneling your expenses that you're going to incur anyway through your business to get a little discount, this is when you start to multiply your money. There's rarely a trip where I go on these days and I don't do some kind of business on, therefore can't write off the airfare, hotel. I just went into a deal into Las Vegas for that silver.
Fun. Okay.
You gotta get creative. The downside of that is you drive your adjusted gross income all the way down, and it makes it harder for you to qualify for these loans because the bankers, they want to see that you're making a positive. So you got to weigh the pros and cons of that. These days, I don't invest in rentals and get debt we're doing more commercial loans. So for me, it doesn't really matter. But when you're investing in these rentals, your personal credit score and your income and your debt service coverage ratio is going to really matter. So you have to weigh that for.
Okay.
There's a fix and flip calculator back here, but and you're asking about the foreclosure. To me, learn to swim on the shallow end of the pool before you get into the deep end. And if you're going to be making more than professional wage, $60,000, $70,000 a year, I'd say don't screw around with this stuff. I haven't met anybody who was a house flipper who got their net worth over a couple $1 million. Put it that way.
Okay.
Yeah, because when they do this type of stuff, they make a lot of money, but it's ordinary income and it's not passive income, which we like. Yay, passive income, ordinary. But yeah, so this is the next homework assignment. Just going through, understand how to put it through this analyzer. We're recording this in 2021 and in 2022, the market will change. And the market changes every 6 months, where some of these, the rent to value ratios, what you're paying will change. So if somebody's watching this video a couple years from now and you're like, shoot, that property, or I can't buy properties at 1.1% rent to value ratio, right? Yeah, man, like the things always change. Things aren't getting better typically. So you have to know where the water line is so you can make good educated offers or know what properties are worth based on the rents that they bring in. So the recommendation is go analyze several dozen properties. So you start to build like a scatter chart, and I would map out the rent to value ratio and the rents and then the price of the property, so you know where they cluster around. So if you see a property that's like way up there, that's a bad deal, right? That's a sucker deal. Ideally, what you're trying to find something that's in the good area, better rent to value ratios, but also be on the lookout that there's a reason why there's out. You might be like, oh, there's a property that's 1.4% rent to value ratio. Don't be that person who gets suckered in by those big numbers, because there might be a reason why, right? Could be next to a blighted house, could just be a lot of deferred maintenance. Usually things are too good to be true, and it's like that. Again, another thing here, did you get the whole argument about like this property has some of the lower rents have better rent to value ratios than some of the ones at 900 to 1,000 typically? We just had a student that just went through and bought like a property at like $70,000 and it rented for $850. So the rent to value ratio was really good. It was like 1.1, 1.2. But normally we suggest you guys not to do that because they're crappy houses. Like we'd rather you guys stay above $80,000 to $90,000 and above, because somewhere in that range, like you can't sell the property. It's like You're never going to have an owner want to buy a piece of junk, $70,000 property or $80,000 property or less. If that makes sense.
Oh, and then just looking at like the down payments on the left, in what cases would the down payment be like 25%, not 20% down payment, which is what I typically hear from the course and you?
Like they might want more. I would say if your credit isn't as strong, but it should be 20, 25%. If that's the case, and then your lender's telling you that you need more, you probably might need a new lender. But if your credit score is like 600, 650, you should be getting a pretty decent, you're a pretty decent borrower, and your debt service coverage ratio is higher than 50%. You should pretty good to go.
Okay.
It's simple at the end of the day, but yeah, there's a lot of good questions you got that kind of throw off new investors. But yeah, usually assume for 20% down payment.
Okay. Then should you be suspicious if it's like below 20%? Are they trying to like lure you in?
They just won't do that. You're probably right. If that's the case, look at the interest rate. The interest rate is probably going to be a lot higher. But the loans that we're going for are pretty ubiquitous. They're just the Fannie Mae, Freddie Mac loans. They're subsidized by the government. So the government says if the loans follow this criteria, if the borrower has a certain credit score, good debt service coverage ratio, that the property meets certain guidelines, it'll fall under the Fannie Mae, Freddie Mac guidelines. And then that way the government will back it in case you, the borrower, if it falls through and you stop paying. Therefore, it's a lot less risk for the bank because they can just unload it to the government should something happen. So therefore, it's cheaper. And therefore you as the customer pay less interest and have these fixed terms. So all banks you go to, and there's a lot of like daisy chain lenders who out there, they all should be going after this gold standard Fannie Mae, Freddie Mac loan. Now where things get really complicated is if you have a borrower that has a really bad credit score, doesn't have good documented income. Now you're going to a subprime market is what they call it. So basic crappier loans. You just don't want to do that, I think. If you can't get the Fannie Mae, Freddie Mac, you can't fit that box, I would say don't buy it. Just figure out what you need to do, improve your credit, and then buy it from there. But I think you're going to have to show at least, the hardest thing for folks getting started is they're going to show at least a couple years of income statements to get. That's going to be the hardest.
Okay. Those are all the questions on my end for now.
So yeah, the next step is to like just build this spreadsheet out to a couple dozen. And then at that point, you're smart, you'll figure out where the water line is, and you should be paying for a certain rent or a certain price property, what you should rent for. And then you just do that for that submarket, which I would probably define as maybe a 10 to 20 mile radius or less, much less than that, but at most 10 to 20 miles. Any other last questions on this?
I'm just going to say no for now.
Yeah, I think you just got to move through the process. I think this is where a lot of investors get, and this is where you have to just do the work, right? You got to find properties and put it into the analyzer. Even though these properties may or may not be good properties to buy, just got to do the work and go through the exercise and start to learn the process.